In this video, let me decode about what is shares outstanding and its exact relevance. If you see a company which is listed in the stock market, so it's called a stock. A company, say BB Industries, is owned by me, Bijoy. Now, I want to further expand the business. Currently, it is just 1 crore business. I want to expand that to say a 100 crore business. For that, I want capital, and I don't want to raise capital just by taking loan. So what will I do? I will list that in the stock market and say I will split the entire company of mine, BB Industries, into a number of shares. So the complete ownership is there and that is split into a number of shares. So that number of shares is called the shares outstanding. Say this company is owned by me and say my friend Piyush is having some stakes in that. So this is like unlisted shares which is say bought by Mr. Piyush. So this unlisted shares also become the part of the shares outstanding. Now the IPO came in, the company got listed. So now the market cap of the company is say 10 crore. So what is market capitalization? Is equal to the current market price at which the stock is traded. Say on the IPO listing day, it went up and all those things, say, and it settled down at 100 rupees. So 100 into number of shares outstanding. Say it is 100 shares for simplicity purpose, for discussion purpose. So 100 into 100 is 10,000. So 10,000 rupees is the market capitalization of that company. Now coming to the exact doubts which the investors normally have. So total number of shares includes the stakes of the promoter, which is me, then the retail investors like you who is getting invested in that stock once the stock gets listed in the secondary market after the IPO. So IPO is the primary market. After listing in the stock market, it is called secondary market. So the shares of that stock is available for everyone to invest in. So that's the secondary market. Then there are institutions, say HDFC Bank or maybe Vanguard from outside India, foreign institutional investors, domestic institutional investors, mutual fund investors. So all these things also gets invested in the particular company if they find potential in that. So promoter, retail investors and institutions form the total shareholding of the company. Now the doubt here is that does the entire company gets listed in the stock market? Means the market capitalization, whatever you tell, is it the entire net worth of the company? Yes. Though promoter, say I have listed 40% of the company and 60% of the company is with me, which is the promoter stakeholding, say 60%. So 60% of the company is owned by me, but the entire company's net worth is divided by the number of shares outstanding and it is been listed. So shares outstanding includes the stakes of all the stakeholders, including that of promoter. So the shares outstanding equal to total shares minus the treasury shares. So what is this treasury shares? Say for an example, after IPO is listed, BB Industries, and I got lot of revenue, profit, and then I wish to buy back the company because I have listed the company because I wanted to raise capital. And if I go for loan, then I have to pay an interest. So that interest and interest cost I wanted to reduce. So I had listed that company publicly. But now that I have got a lot of profit, I have enough capital, I want to buy back the company. Buying back, first thing, taking back ownership of the company, a part of it, showing investor confidence. And the other part, as far as the metrics are concerned, is that now shares outstanding is say 100 shares, out of which 60% is with me and 40% is with others, retail investors and institutions. Now, if I buy back the company, number of outstanding shares reduces, right? So if the number of outstanding shares reduces, then whatever is bought back goes to the treasury shares. Note, this is not a promoter share, but this is the promoter buying back the company shares. So this treasury shares directly goes to the company, which is end of the day owned by the promoter only, but then it doesn't have voting rights and it is not eligible for any dividends. It directly goes to the company's holding. Note that promoter shareholding, retail investors and institutions has got voting rights and can share dividends. While buying back, the profit of the company is there, it is same, and the number of shares outstanding reduces. So total profit divided by the number of shares outstanding gives you the earnings per share. So the earnings per share increases because the number of shares outstanding is reduced because the company has bought back the shares and deposited that as treasury shares. So denominator reduced means the total value increases. So earnings per share increases. Hence the ROE, the return on equity also increases. So the investors thinks that the P ratio has reduced because earnings has increased, the price is the same. So price divided by earnings, it will look attractive. The ROE also has increased and the earnings per share also has increased. This is all by calculation purpose. But end of the day, you know that the profit of the company is the same. Only the shares outstanding has reduced. Because of that, the company projects itself as having higher earnings. So this will make the company look financially metric wise cheaper and attractive, and this pushes investors, especially retail investors, to invest in them. Now as the buyback happens, the number of shares outstanding reduces. So often I heard people telling that the promoter has increased the stake in their company, and the last year it was 62%, now it has become 64%. It is not that while company is buying back the shares, the percentage of that share or the number of shares outstanding goes to the promoter shareholding. Not like that. It goes to the treasury shares. But then as the total number of shares outstanding reduces, percentage wise the promoter holding increases. It's not the number of, so note that it's not the number of shares of the promoter getting increased, but the total number of shares gets reduced. So percentage wise the promoter holding increases. Hope this clarifies. So you should now know that market cap is price you pay for the company, and book value of the company is the actual net worth, at least on the paper. So IT companies have goodwill, so the book value may look inflated. That's a total different story. But then price is what you pay, which is the current market price, which is the market capitalization, and value is what you get, the book value of the company, the net worth of the company. Hope this clarifies all your doubts about shares outstanding. So while you buy a company now, you clearly know that you get pie of the business, whether it is a fraction of it. But then even if you hold one unit or one shares outstanding of that company, you are part owner of that company. So take ownership of that company, invest wisely, and take part in the growth journey of that company. See you next video. Till then, happy investing.